Yemen controls the Bab-el-Mandeb. Global insurance rates explode. West runs out of options. On April 28, 2026, at approximately 6:15 UTC, the impossible became official. Lloyd's of London, the 338-year-old insurance market that has underwritten maritime risk since the age of wooden sailing ships, issued an emergency bulletin reclassifying the Bab-el-Mandeb Strait and the southern Red Sea as a listed area under the Joint War Committee's hull war, strikes, terrorism, and related perils designation, the highest risk classification available, equivalent to a war zone. For the first time in the history of modern maritime insurance, a non-state actor, the Houthi movement of Yemen, has imposed a risk classification on a global waterway that equals or exceeds the classifications applied to the Persian Gulf during the Iran-Iraq War's tanker war of 1984 to 1988. War risk insurance premiums for vessels transiting the Bab-el-Mandeb have exploded from approximately 0.05% of hull value to approximately 2%, an increase of 4,000% in less than 18 months. For a standard Panamax container ship valued at approximately $45 million, the war risk premium alone now exceeds $900,000 per transit. The world's poorest country has just imposed $1 billion tax on global commerce, enforced not by a navy, but by a missile, not by a treaty, but by a threat, and the West has run out of options to stop it. How did Yemen achieve effective control over the fourth most important maritime choke point on Earth? Why has every military response by the United States and its coalition partners failed to restore freedom of navigation? What does the insurance reclassification mean for global trade, consumer prices, and the economic stability of countries that depend on Red Sea shipping? And what options, if any, remain for the Western Alliance? Stay with us. If you want analysis that counts the cost instead of repeating the narrative, hit the like button, subscribe, and turn on notifications. Drop your thoughts in the comments. The Bab-el-Mandeb Strait, that 26-kilometer-wide passage connecting the Red Sea to the Gulf of Aden, is one of 4 critical choke points through which the arteries of global commerce pass. Approximately 12% of global trade transits through the strait annually. Container ships carrying manufactured goods from Asia to Europe, oil tankers carrying Gulf crude to Mediterranean refineries, LNG carriers supplying European energy markets, grain freighters feeding North African and Middle Eastern populations. The alternative route around the Cape of Good Hope adds 6,000 nautical miles in 12 to 15 days to the standard Asia-Europe voyage, increasing fuel costs by approximately $300,000 to $500,000 per transit and pushing total voyage costs high enough to render some trade routes economically unviable. The strait is not optional for the global economy. It is structural, and the Houthis have seized structural control of it through a strategy so elegantly asymmetric that the world's most expensive navy has proven unable to break it. The Houthi arsenal now includes, according to intelligence assessments compiled from operational data, the Tufan anti-ship ballistic missile with a 200-kilometer range and maneuvering warhead, the Quds family of cruise missiles with ranges between 200 and 800 kilometers, the Samad drone family with ranges exceeding 1,500 kilometers, explosive-laden unmanned surface vessels, and most recently, underwater explosive drones capable of targeting vessels at anchor or at slow transit speeds in the strait's approaches. The cost of this arsenal, supplied by Iran at an estimated $300 to $500 million per year, is a rounding error in the context of global defense spending. The damage it has inflicted is measured in tens of billions of dollars in disrupted trade, rerouted shipping, increased insurance premiums, and the operational costs of the multinational naval forces deployed to counter it. The cost-exchange ratio tells the story of why military options have failed. Each Standard Missile-6 interceptor fired by an American Arleigh Burke-class destroyer cost between $2.1 and $4.3 million. Each Houthi drone being intercepted cost between $15,000 and $40,000. Each cruise missile costs between $100,000 and $250,000. The ratio runs between 50 to 1 and 200 to 1 in favor of the attacker across the threat spectrum. The U.S. Navy has expended over 300 SM-6 and SM-2 interceptors since the campaign began, at a total cost exceeding $800 million in munitions alone. The Houthis have expended an estimated 500 to 700 weapons at a total cost of perhaps $50 to $70 million. The attacker is spending a fraction of the defender's cost and is being resupplied continuously by Iran through maritime corridors that Western navies have proven unable to fully interdict. The insurance reclassification is the mechanism through which Houthi military action translates into global economic damage, and it operates with the mathematical precision of a financial instrument rather than a weapon. When Lloyd's classifies a waterway as a listed area, every vessel transiting that waterway must purchase additional war risk insurance from the hull war market. The premium is calculated as a percentage of the vessel's insured value. At 2% of hull value, a container ship valued at $45 million pays $900,000 per transit. An oil tanker valued at $120 million pays $2.4 million per transit. An LNG carrier valued at $200 million pays $4 million. These costs are passed through the supply chain to the end consumer, the European household paying more for goods shipped from Asia, the North African consumer paying more for grain shipped from the Black Sea, the global airline paying more for jet fuel refined from Gulf crude that must now transit the Cape of Good Hope at a cost premium of $300,000 per voyage. The Houthis have not closed the Bab-el-Mandeb. They have taxed it, and the tax is being paid by 8 billion people who have never heard of the Bab-el-Mandeb and do not understand why their groceries cost more. In Washington, the Pentagon has acknowledged, in classified assessments shared with congressional leadership, that the current naval deployment cannot sustain the interceptor expenditure rate indefinitely. SM-6 production, manufactured by Raytheon at a rate of approximately 125 units per year, cannot keep pace with expenditure rates that have averaged over 20 rounds per month since the campaign began. At current rates, the Navy's SM-6 inventory will reach critically low levels within 12 to 18 months, forcing a choice between reducing Red Sea deployments or degrading missile readiness in other theaters, particularly the Pacific. In London, Lloyd's underwriters are pricing the risk based on actuarial models that now assign a 17% probability of a vessel being struck or damaged during a Bab-el-Mandeb transit, a probability high enough to make some trade routes commercially uninsurable at any premium level. In Brussels, the European Commission has estimated that the Red Sea disruption has added approximately 0.4 to 0.6 percentage points to Eurozone inflation, a figure that translates to approximately 40 to 60 billion euros in additional costs borne by European consumers annually. In Beijing, China has declined to participate in the multinational naval escort operations, instead pursuing bilateral security arrangements with the Houthis through Iranian intermediation, a channel that has reportedly resulted in Chinese-flagged vessels receiving safe passage through the strait, while Western-flagged vessels continue to be targeted. In Moscow, Russia views the Houthi campaign as a strategic gift that degrades American naval readiness, increases European economic pressure, and demonstrates the limitations of Western military power against asymmetric threats, all at zero cost to Russia. In Riyadh, Saudi Arabia, which fought the Houthis for 9 years at a cost of $200 billion and achieved nothing, has accepted the reality that the Houthis cannot be militarily defeated and is focused instead on diplomatic accommodation through the Chinese-brokered ceasefire. First, the Houthis have achieved effective control over the Bab-el-Mandeb Strait through asymmetric military action that imposes costs on the defender at ratios of 50 to 100 100 to 1, a ratio that makes sustained military defense economically unsustainable. Second, the Lloyd's insurance reclassification translates Houthi military action into global economic damage through a financial mechanism that no military response can address because it operates in the actuarial market rather than on the battlefield. Third, the U.S. Navy's interceptor expenditure rate exceeds production capacity, creating a depleting asset dynamic that will force operational changes within 12 to 18 months. Fourth, the West has run out of military options that do not involve direct confrontation with Iran, an escalation that carries risks, economic, military, and nuclear, that no Western government has the appetite to accept. April 28, 2026 will not be remembered as just another date in the Red Sea crisis. It will be remembered as the day the global insurance market, the cold-blooded actuary that respects no flag and salutes no general, declared officially what every strategist already knew, that the world's poorest country has achieved effective control over one of the world's most critical waterways, that the world's richest military alliance has failed to prevent it, and that the cost of this failure is being paid not by governments or generals, but by every consumer on Earth who buys goods that once traveled through waters that are no longer safe. What do you think the West should do? Negotiate with the Houthis? Escalate against Iran? Or accept the rerouting? Drop your honest answer in the comments. We read every one. Hit the like button, subscribe, and turn on notifications. Until next time, stay sharp.